Warren Buffett is a legendary example of how mastering financial statements alone can empower world-class investment decisions. Buffett is known for making multi-billion-dollar investments in companies, sometimes without visiting their headquarters, meeting the management, or commissioning deep strategic due diligence. His reasoning? The numbers tell the story. He believes that a company's financial statements reveal more than any sales pitch, glossy presentation, or CEO interview. Here's how. Income statement, durable profitability, consistent revenue growth over several years, high and stable profit margins, strong net income even during downturns, balance sheet financial strength, low debt levels relative to equity, strong asset base, especially cash and receivables, owner's equity growth year over year, cash flow statement, real cash, not accounting tricks, free cash flow, FCF, as a sign of value generation, operating cash flow matching or exceeding net income, avoidance of companies with negative or volatile cash flows. In 1988, Buffett invested over $1 billion in Coca-Cola, mainly by analyzing their financials. What he saw: massive global reach and pricing power, visible in income growth, little debt and high returns on equity, balance sheet, predictable and growing free cash flow. Lesson for learners: if you can read financial statements, you can speak the language of business and make smarter investment decisions than most people ever will. Financial statements are the foundation of fundamental analysis. They offer a structured summary of a company's financial performance and position. Investors, analysts, and other stakeholders rely on them to assess the health and profitability of a business. There are three main financial statements every investor should understand: the income statement, the balance sheet, the cash flow statement. The income statement shows a company's revenues and expenses over a specific period. It reveals whether a business is profitable. Key components: revenue or sales, the top line showing total earnings from operations. Cost of goods sold, COGS, direct costs of producing goods, services. Gross profit, revenue minus COGS. Operating expenses, costs related to running the business, for example, salaries, rent. Operating profit, EBIT, earnings before interest and taxes. Net profit, the bottom line, what remains after all expenses and taxes. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It follows the equation: assets = liabilities plus shareholders' equity. Key sections: assets, what the company owns, for example, cash, inventory, property. Liabilities, what the company owes, for example, loans, accounts payable. Shareholders' equity, owner's residual interest after liabilities are subtracted from assets. This statement tracks the flow of cash in and out of a company. It helps determine the firm's liquidity and cash generating capacity. Divided into three parts: cash flow from operating activities, cash generated by core business; cash flow from investing activities, cash used for or generated from investments in assets; cash flow from financing activities, cash from issuing, repaying debt or equity. By mastering financial statements, investors can identify profitable versus unprofitable businesses, assess debt levels and cash flow health, compare companies across sectors, detect potential red flags, for example, inconsistent cash flow, rising debt. Fundamental analysis starts with reading and interpreting these statements correctly. They are the building blocks for valuation, forecasting, and investment decision-making. Peter Lynch, legendary manager of the Fidelity Magellan Fund, delivered an average annual return of 29% between 1977 and 1990. He often emphasized the importance of simple financial ratios in identifying high-performing stocks. For example, Lynch famously used the PEG ratio, price to earnings to growth, to identify undervalued growth stocks. He believed that a company growing at 20% with a price to earnings ratio of 20 was fairly valued, resulting in a PEG ratio equal to 1. If he found a company growing earnings at 20% with a price to earnings ratio of 10, he knew he had found a bargain, since the PEG ratio would be less than 1. Lynch's success highlights how mastering just a few key financial ratios can lead to extraordinary returns. Financial ratios are mathematical comparisons derived from a company's financial statements. They allow analysts and investors to quickly assess aspects of a company's performance, such as profitability, liquidity, leverage, and valuation. Used correctly, they help compare companies across industries or monitor changes over time. Gross margin is calculated as gross profit per revenue. It indicates how efficiently a company produces goods. Operating margin is calculated as operating income per revenue. It measures how much profit a company generates from core operations. Net margin is calculated as net income per revenue. It shows the percentage of revenue left as profit after all expenses. Current ratio is calculated as current assets per current liabilities. It measures the ability to cover short-term obligations. Quick ratio is calculated as current assets minus inventory per current liabilities. It is a stricter measure of liquidity than the current ratio. Debt-to-equity ratio is calculated as total debt per shareholder's equity. It assesses financial leverage and risk. Interest coverage ratio is calculated as earnings before interest and taxes per interest expense. It indicates how comfortably a company can pay interest on its debt. Price-to-earnings ratio is calculated as price per share per earnings per share. It shows how much investors are willing to pay per dollar of earnings. PEG ratio is calculated as price-to-earnings ratio per earnings growth rate. It adjusts the price-to-earnings ratio for growth, which is useful for growth stock evaluation. Price-to-book ratio is calculated as market price per book value per share. It compares market valuation to net asset value. No ratio tells the full story in isolation. For example, a low price-to-earnings ratio may indicate undervaluation or poor future prospects. Comparing ratios within the same industry and understanding trends over time is essential for meaningful analysis. Using financial ratios effectively requires both numerical skill and a feel for the business context. In the early 1990s, George Soros correctly predicted major changes in the United Kingdom's financial system, particularly its vulnerability within the European exchange rate mechanism, also known as the ERM. By analyzing macroeconomic indicators and sector weaknesses, specifically the banking sector's reliance on unsustainable interest rates, he made a historic $10 billion bet against the British pound. This trade, known as breaking the Bank of England, was driven by sector-level insight and remains one of the most iconic examples of industry-focused fundamental analysis in history. Understanding the sector a company operates in helps contextualize its performance. Even a strong company can underperform if its industry is in decline. Sector analysis helps investors compare companies within the same group, understand macroeconomic sensitivity, and identify emerging trends and risks. Sectors are broad segments of the economy, for example, technology, healthcare, and financials. Industries are more specific categories within sectors, for example, within technology, semiconductors, software, and IT services. Classification systems like the Global Industry Classification Standard, or GICS, are often used by analysts. Cyclicality considers whether the sector is cyclical, such as consumer discretionary, or defensive, such as utilities. Regulation refers to whether there are specific government controls or subsidies. Innovation pace addresses how fast the industry is evolving. Profit margins recognize that some industries are naturally more profitable due to lower competition or capital intensity. Industry research tools include industry reports, such as those from IBISWorld and Morningstar. Sector exchange-traded funds and benchmark indices are also useful resources. Additional tools include news, analyst commentary, and earnings transcripts, along with key financial ratios compared across industry peers. Before investing in a company, compare it to its peers within the same industry. Ask whether it is gaining or losing market share. Consider whether its margins are above or below the industry average. Evaluate how exposed it is to sector-specific risks. Industry analysis ensures you are not just buying a stock, you are buying into the economics of its entire ecosystem. In Amazon's early years, critics argued that its valuation made no sense. Its price-to-earnings ratio was sky high, and it wasn't making consistent profits. But Jeff Bezos and long-term investors understood that traditional valuation methods, like price-to-earnings, were not suited for high-growth tech companies. Instead, forward-looking valuation models like discounted cash flow, abbreviated as DCF, which projected Amazon's future cash flows, showed the massive upside potential. This perspective helped early investors stick with the company and reap exponential returns over time. Valuation is the process of determining the present worth of a company or asset. It helps investors decide whether a stock is overvalued, undervalued, or fairly priced relative to its fundamentals. Discounted cash flow is a method of valuing a company based on its expected future cash flows discounted to present value. The formula for present value is the sum of cash flow in year end divided by 1 plus the discount rate raised to the power of n. The key inputs include projected free cash flows, the discount rate, usually the weighted average cost of capital or WACC, and the terminal value. The strength of DCF lies in its strong theoretical foundation. However, its weakness is that it is highly sensitive to assumptions. This method compares a company's value to others in the same industry using key multiples. The price-to-earnings ratio is calculated as price divided by earnings. The enterprise value to EBITDA ratio is calculated as enterprise value divided by EBITDA. The price-to-book ratio is calculated as price divided by book value. The price-to-sales ratio is calculated as price divided by sales. This approach provides a quick way to see how a company stacks up against peers. Discounted cash flow is best used for companies with stable and predictable cash flows, such as utilities. Multiples are more appropriate for high-growth or cyclical companies where forecasting cash flows is harder. Technology startups may not yet have earnings, so revenue-based multiples like price to sales are more relevant. Common pitfalls in valuation include overly optimistic growth assumptions in discounted cash flow models. Another mistake is comparing companies with vastly different business models. Ignoring debt in valuation is also problematic. In such cases, using enterprise value-based multiples instead of just market capitalization is more appropriate. Additionally, forgetting the impact of macroeconomic conditions, such as the influence of interest rates on discount rates, can lead to inaccurate conclusions. Ray Dalio, founder of Bridgewater Associates, built his investment empire by understanding how macroeconomic factors like interest rates, inflation, and currency trends affect asset prices. One of his most famous insights was predicting the 2008 financial crisis by analyzing the credit cycle and excessive leverage in the United States economy. Dalio's principles emphasize that no company operates in isolation. Understanding global macro trends is crucial to predicting how sectors and individual stocks will perform. Global macro refers to the analysis of large-scale economic and geopolitical factors that influence financial markets. These include interest rates, inflation, fiscal and monetary policy, currency movements, and international trade dynamics. Interest rates are a critical indicator. Rising interest rates often hurt stocks, especially growth stocks, while falling interest rates tend to support them. Inflation is another key factor. Moderate inflation supports corporate profits, while high inflation can erode profit margins and reduce consumer spending. Gross domestic product or GDP growth also plays a major role. A growing economy typically boosts stock prices, while slowing growth or recession can depress them. Employment data signals economic strength or weakness and has a direct effect on consumer-driven sectors. Central bank policy, including decisions by institutions such as the Federal Reserve or the European Central Bank, impacts market liquidity and investor sentiment. A strong domestic currency tends to hurt exporters but benefits importers. In contrast, a weak domestic currency helps exporters by making their goods more competitively priced abroad, but it raises input costs for importers. Trade policies, including tariffs, trade agreements, and sanctions, can drastically affect performance across different sectors. Geopolitical conflicts can cause short-term market volatility and shift investor focus towards safe haven assets. Pandemics or natural disasters disrupt supply chains and negatively impact sectors such as travel, energy, and logistics. Global financial crises can shake investor confidence across the world, even in markets that are otherwise unrelated to the originating event. To integrate macro analysis into stock selection, begin by analyzing how sensitive a company or sector is to interest rates or inflation. Use macroeconomic trends to guide timing decisions, such as investing in cyclical stocks during periods of economic recovery. Tracking central bank communication can also provide early signals of policy shifts. Global macro analysis helps investors understand not just the company, but the world it operates in.